Welcome everyone to another episode of the Unquestioned Podcast with Louise Bode and Willem Hinton. How are you guys doing? Luigi, we are in the life and flesh on our screen. How are you doing, mate?
All right. I want to know how your Valentine's was.
Ooh, my Valentine's. That's my private life. I don't share that. But you asked me, so I will share it anyway. Uh, I went actually to Germany.
Uh-huh.
Now that I drive an electric car, I feel like it's cheaper to drive.
Ah, for Greta.
You see, I'm one of those people that just
No shame.
no shame and just drop it there. I'm vegan. I drive an electric. No. I'm not vegan for the listeners.
These are very 2024 talking points, but
Okay, but long story short, it was actually my third trip now with an electric car, and I really together to celebrate my relationship with Billy Sher. We went to the Black Forest to do amazing hikes and do a little bit of a plunge in a local lake. So that's always you take with you. So I really loved it. And how was your Valentine, Luigi? Or you said like you were on the hunt.
I spent a beautiful day at sea having lunch with my grandma. Um,
Mm,
and
listen,
she was
that is
she was a
a
little bit pissed.
future.
Yeah, be-
What?
because
Why?
well, no, because she did realize that it was Valentine's weekend and all the good spots. You know how these old people they know. Oh, this is a good place to eat.
Mm-hmm.
Were booked. So we had lunch at a like a less than ideal little brasserie,
Mm-hmm.
and she was complaining about the restaurant as we were sitting there, which is typical for grandparents. And the night before, at a familiar location,
Mm-hmm.
familiar to you in Dock Noord, I did a speed dating event where I had like 10 dates
Mm.
um, with yeah, random new people, but yeah, nobody stuck. But I have yeah,
Well,
I'm
let's say
very choosy.
the perfect son-in-law that goes on Valentine with his grandmother for lunch. That title you already have. Now we just
Yeah,
need to find a
I
partner.
have other priorities. Yeah, sorry.
Well, talking about priorities, you really wanted to talk on this episode about taxes. That is kind of, let's say, not one of the sexiest topics you can talk about, or maybe it is. So maybe let's hit it up, Louis. Why did you want to talk about taxes?
It's actually because of your country of
My
your
country?
country of choice, the Netherlands.
Oh.
They they came to like it came to international attention that they're trying something new, and they're referring to it colloquially as the Box 3 tax. Box 3 is a name for um, certain tax that applies to certain things that you own, and
Yeah.
it's been around, but they're gonna renew it, and then there's a very new feature.
Ma-
Yeah,
Maybe to for the listeners to break it down.
yeah,
So first of all, you have in the Netherlands a system with let's say three boxes, and the first box is your income tax. So basically, you do a job, you get paid by that employer. Either if you now do a good job or not a good job, you get paid, and a little piece of that is given to the government. So that's kind of what comes in box one. And then the second one is more kind of your box two. They call it inkomen uit aanmerkelijk belang. So it's like based off dividends, based off you as a company as well. If you have a company that have to pay taxes upon that, and then box three is kind of your wealth that gets taxed on. So that is like on savings and investments, and it's this box three that is currently as well that they kind of expanding
it's
because
under attack. Yeah.
it's under attack in a way. Yes.
Thanks for setting the stage there. That's actually a good. So those are the three boxes. Um,
Those are the three boxes that I know of.
yeah.
I've
And
but
this was is this an existing classification? And as I understand it, by 2028, they have a proposal for a new type of taxation, specifically applying to Box3, right?
Yes. So this is the in Box3 the unrealized capital gains tax. So to we both are maybe not eligible to go into the whole tax law of the Netherlands, but it's maybe very interesting to go deep into this, let's say, new law that they want to bring in. And basically, what it says is you will be taxed on unrealized gains based off your investments. So let's say you invested into a very fun example, Bitcoin, and suddenly Bitcoin really goes up, and by the end of the year, it's doubled in price. Now, actually, because of you did an investment, that is should as well the taxman should come by and take a little piece of it. Okay, but you haven't realized it yet. So let's say
What does that mean? What does realizing mean?
realizing mean is when actually the euros, dollars, or let's say the money is in your pocket.
When you sell the asset.
When you sell the asset and you have kind of a liquid form of I would say of value, which can be euros in your hand, or it can be a golden bar that is then you have it in your hand, I would say. And unrealized, if it's, let's say, your the potential, maybe to rephrase it, unrealized gains, or the asset that you have and it grows in value but you haven't sold it yet, it is still kind of it is still, let's say, on paper or in a digital format. It's not in your hand and kind of realized that you
But the
have
gold
it, that no one
bar,
can take it away anymore.
yeah, the gold bar is actually a good example as well, because people talk about investments like stocks, but it applies, I think, to gold too. If you bought gold and gold appreciated a big time in the last few years, you realize your gains. So if it grew, you see your profit once you sell the gold, and you will be taxed on that. You would be taxed on that almost everywhere, like in Belgium, for example, but only at the point of selling, because then we can make the difference between you bought it for this price, you bought it when gold was this amount of euros an ounce, and let's say you bought 100 grams of gold, and now you sell that. The difference, if it appreciated in value, is your profit. You will pay a piece of tax on that. That's because, I mean, you're basically exiting your position.
Yeah.
But the unrealized part is now that even if you don't touch it, if you let it compound, which is the secret to growing your wealth, you're still going to be hit with a 36% tax on the increase in value. And that is new, right?
And I think that's quite problematic because you're being, let's say, taxed, or you have to pay based off something you don't have yet. And I'll try to simplify it because it's difficult even. And with an example, it's the easiest, I think, is to go back to Bitcoin. Let's, for example, Bitcoin is worth, to very simple, in the past, it's worth 100 euro.
Yeah.
And let's say it really blew up. Like we all know, Bitcoin blew up, and it went
10x.
10x. Yes, it goes to $1,000 for one Bitcoin. You're super happy, and the
What's my
government also.
profit?
What's your profit? Yes, your profit would be that 900 euro that it's gained. So that is kind of your capital gains that you would have. But you don't have yet $900 in your extra in your pocket. You just have still that one Bitcoin, but that Bitcoin is now valued at $1,000 instead of $100. So what happens is you get taxman comes and says, "Oh, you made 900 capital gains. Well, we're gonna take specifically 36%, what they say in the Netherlands, we're going to take away from that. So 36% of that 900 dollars that you've gained, they will ask. Well, maybe you have some other some income or some other money. You need to take it from there and give it to the taxman. And then let's say a couple months, you say like, "Oy, I actually want to realize now maybe and sell my Bitcoin." I look back at the market. Oy, there was a Bitcoin crash, and suddenly it's only worth $200. So what's the problem now? You've actually paid massive amount of tax on where the government thinks like, oh, this man is very rich. He made $900 in Bitcoin, but actually you didn't do that because you only later sold it. So this creates wrong incentives.
Yeah, you're pointing at the problem. Yeah, exactly. Because
it's you go.
Yeah, if we followed that the inverse, and let's say you're a very dumb investor, and you buy gold at the very peak at I'm just gonna simplify at $1,000 for a particular gold coin, and everybody loses trust in gold and it halves, then if we would follow the same logic, you're supposed to be getting money from the state because you had a huge loss, and that's what was my first thought as well. I thought this is ridiculous. This can't be. So of course they made an adjustment. I mean, it's still a very bad idea, but the improvement that they made for that is that you can write off the loss, meaning over the years it's gonna cancel out and equal out, because if 1 year your very volatile asset like Bitcoin or Tesla stock, if it goes down by 30%, you can write off that loss, and then the next year, if it goes up again by 30 or 50%, you're only going to have to pay the 20% increase, or if it doesn't increase all the way back, then you're not owed anything, because it's relatively, looking back over the years, it didn't appreciate. So luckily there is that, and what it really does, I think, is it basically lowers your returns to it, like stabilizes and lowers the volatility of your returns. You're basically always giving up a piece, and instead of having a very good year 1 year, it's always going to be a mildly mediocre year. Is what I see happening.
Yeah. Well, to add a little bit on that, why I personally really think this kind of law, which they're thinking of putting in action, is extremely bad, because it creates the bad incentives. Because you kind of create an incentive for people to quicker take their wins. And like you said yourself, the most amazing wonder, or the eighth wonder in the world, is compound interest, where because you keep your money into certain asset, and the interest or the growth itself becomes, or the interest, you make money on the interest, and that is kind of this really accelerating effect. And by implementing a law where you're literally been told like, you at this point of time you made that much money, now you need to be taxed upon that, you kind of incentivize the person like, okay, I maybe have to sell it now so that I can actually pay the taxman. So you create incentives for people not to think long term and only do short term actions. Plus the other thing as well, often you have transaction costs and other stuff, so it makes it all a lot more complicated. And the fundamental how a lot of people get rich or become a millionaire is because they keep their money and they don't sell, and this is kind of one of the very dangerous things that you create. That's kind of my point.
You framed it really well. It eliminates long-term thinking, because that belief that especially people have that want to let's say move up, not on the corporate ladder, but really move up a class in the world, and
just a network there.
And really increase their wealth. They're looking for that 10x. And another problem with it is that it will make people more risk averse. Why? Why will they take less risk? Because I sometimes invest in things that are not a sure thing, that can be very volatile, but that have a very high payoff. And for me, it's really not worth it to. Am I going to be incentivized to do more of that type of investing, of like long shots of special experiments? Because I'm counting on the fact that if they succeed, that I get 10x or 50x my money. But if I already have to give 36% away of my 50x, that's supposed to take me to the moon, then I might as well not bother. I'm gonna be like, okay, give me the sure thing and optimize my taxes. So
Yeah, and that's kind of, it really pisses me off about Europe. It's just is they
angry
keep on
Willem.
angry with them. It just keeps on finding little laws or rules to kind of make people, let's say, yeah, less fan of risk, and saying like it's already so tough you as a person to live, to wanting to take risk, to make a better, let's say, living standard for you, your family, and so on and so on. And you, by investing into, let's say, assets, which can be equities, which can be a house, which can be a business, and so on. All of these extra rules and taxes we place on these people who take risks demotivates them, and kind of really to like demotivates them to yeah, make the
Try
pie bigger,
things. Yeah,
because
yeah.
everything, what makes the pie bigger is people that start businesses, people that take risks, people that invent new things. These all make the pie bigger, and if we don't make the pie bigger, you could say, yeah, then the problem is the pie will be start shrinking and shrinking. And it's maybe hard to say it with that analogy, but to
There's going to be
survive.
less diversity in rich people. It's the rich people are going to remain the same. Because here's my twist. I did some research on this. The worst aspect of this whole law is, I thought to myself, how is it possible that the Heineken family, for example, or whoever, that the very rich, the really, really rich people of the Netherlands aren't complaining about this? And I looked into it, and I could be wrong, but if you have a company and if your stock is part of a BV, like of an OLSAP, some entity, you're actually shielded from this
Incorporate.
tax. So who is really hit by this is the person, the private that has private property that like buys stock on their phone or has a little bit of gold, and doesn't have the
Everyday
whole
citizen.
infrastructure of having a
A whole wealth
whole
structure set up for their
yeah, a whole
family
company
wealth
set up.
and
So when you suddenly when you get rich enough, you're able to afford lawyers and accountants that can set up a structure that is not affected by this. So that's the really infuriating part about this, because the people that are not going to get rich because of this are exactly the people that you want to make richer, the middle class, the in between, the not the very rich, but the poor people or normal people supposedly that want to move up a little bit in life. So what's happening is you're keeping, yeah, the powerful in power, and the poor people can't even get to the next level.
yeah, and it's sometimes it's just a let's say it looks good on paper. Ah, okay, the people that make a lot of money on equities and that have these unrealized gains, we should tax them. It looks maybe good on paper, but if you make the whole calculation and you look way bigger of what trickling down effects it has on people's incentives, on the economy, and so on, it is not a good idea. And it's funny to see, but it's often also where you lower tax, you lower complexity. Often economies rise upon that, and people take more risk. People, let's say, will do better things for their own lives, or let's say with their family, start companies that really has a positive impact not only on their own lives but also on the people around them. So yeah, that is my concluding talk. Just reduce the complexity and incentivize people to take risks in their life, because it will benefit everyone around them as well.
My conclusion is journalists should step up, and like people in academia, professors, so-called economic experts should step up. And maybe I'm wrong. Maybe I didn't fully understand this law and interpreted it wrong. But if it's really the case that we're keeping the very rich rich this way, I'm almost sounding like a typical hippie here. Like, why don't you speak up about this? What we want is more new rich people. We want some dynamic. We want the dynamic economy. We want the bigger middle class, and this is doing the opposite. So, please, people, what's like? Why aren't we? Yeah, why aren't we making a bigger deal of this?
Yes, I will go on the streets right now in Amsterdam
Thanks.
and shout this
Cold plunge
in the streets.
for the new rich.
Yes. And to add just a little bit on top of that is just it is already so tough to, let's say, grow your wealth, and let's say you should not make it more difficult to do that. And as well, opportunities should be created equal, and based on that you are taking away opportunities sometimes of the everyday man that wants to belong to a class higher, or let's
You've
say
done
a
it.
wealth class tougher higher.
You've done it. You and your hosting country have made me a hippie.
Okay, maybe one last thing before we end the podcast, because there's a lot of as well entrepreneurs and people that make a move, that literally move either countries. For example, Gérard Depardieu, that eventually didn't go through, but it was in France where he wanted to move because there was a big tax law coming in. Other examples, okay, the All In podcast that maybe some of our listeners also listen to, where the one and only David Sachs, who moved from California towards Texas specifically as well. What is your point of view? Or do you have any other examples as well of?
So I will just
why?
quickly give you the devil's advocate. California gave these people so much. Mark Zuckerberg, the Google founders, David Sachs, they've benefited from this great state, and now they're leaving for a different state. That's what the left thinks. But the reason is that they're trying something very similar. They want to do a one-time, that's what they say, 5% ultra-rich billionaires tax. But it's the same thing. It's the same. It's in the same area.
Category.
It's trying to tax money, stuff that's already yours. So it's not part of a transaction where if I buy an ice cream, some part of it goes to the state, or if I decide to sell my house, sell my equity, some part of it. No, it's money and property rights, basically an assault on property rights, and on their paper wealth, on their unrealized wealth, and these billionaires have had it. So yeah, I think it's just the very principle of how far we've gotten are based on getting to keep what is yours, owning it. Maybe make it difficult to pass it down to your children, as we've said before, with an inheritance tax, maybe. But please, especially if my gains have already been taxed before, to get me to this place, you really will drive me to a different jurisdiction if you make life that difficult for me, regardless of how rich I get, because that's the argument in California: is people are way too rich, and they can afford to just this once pay an additional tax. But that's not a good reason, in my opinion.
And to add on that, the final thought is like the ultra rich, they can make a move. They can move away of California. But if you do that, let's say a certain tax on people that let's say, are less wealthy, and they get taxed on things that the unrealized capitals gain tax. To go back to that, they might have to, because a certain stock in their portfolio really went up, have to loan money to pay off their taxes, and then eventually have more debt because a bit later that asset actually declined a lot, and they cannot just say like, okay, I want to move, because they don't have the wealth enough in comparison to the super rich to make those decisions to move. So that's a final thing I as well wanted to share. Well, this was a fun one about taxes.
It was a hard one.
It's it's I think as well, sometimes it's good to really go a little bit deeper into these topics, and I think as well for the listeners, please let us know if you like it. Maybe as well you have some feedback that you want us maybe to do even more deep research, or even go deeper into the numbers. We as well have a full-time jobs, but we really love your feedback, and we really want to make the content for you guys better and better. So definitely comment in the podcast app or wherever you're listening.
Spotify.
Yes. Well, hopefully you guys enjoyed it, and looking forward to welcome you back to another episode next week of the Unquestioned Podcast.